Okay, so I am live. Sorry, I'm a little late. I had a network error. I run a VPN every once in a while, and for some reason it wouldn't let go. That's okay. Little added protection there. So let me get to this. Hold on. We're going to talk about options today. Just popping out the chat so that I can see everybody's stuff. And let's handle some of these questions first, and then I'm going to get to an options primer. So this isn't going to be like an elaborate lecture on options. I'm going to give a high-level view of options, stock options I'm talking about, but this could equally apply to options on futures, but that's a much more specialized case. We're going to focus on options on stock. And the way I'm going to approach this is provide like what I'm going to do in the future, in the near future, in the next week or so around options. So I'm going to tell you what I'm going to tell you, then I'm going to tell you, then I'm going to tell you what I told you, something like that. But before I do that, let's go to the comments and see what people are saying here, just to get some of this out of the way. Francois says, what do you think of Mike Maloney's theory? Like there is a massive housing bubble lurking, likely worse than 2008, and likely to create a domino effect, also way worse than the previous one. Well, obviously, he's been talking to Peter Schiff, and that's very possible. I think that we're seeing a lot of the same kind of predatory practices in the mortgage industry, and although it's nowhere as bad as before. So I don't think it's going to happen anytime soon. Noon says, unlikely the crisis happens 2 times with a housing bubble. Most likely a different and unexpected trigger like Eurozone. I don't know. Okay, fair enough then. Now, how come a rather honest and very informed man like him would not see that? It has nothing to do with honest and informed. You got to keep in mind that the last housing bubble, nobody saw it. Well, very, very few people saw it coming. If you watch the movie The Big Short, you'll find that there was a very select few people that actually saw it coming and then made hay on it. The vast majority of people had no idea that this was a problem. Some of them may have actually caused it and still had no idea. They didn't know what they did. And most people just, go along. But just because Mike Maloney is, quote, honest and informed, both of those dubious distinctions, even if he was perfectly honest and perfectly informed, means nothing, because most experts didn't see it coming. Peter Schiff said he saw it coming, but Peter Schiff is a permabull, and he's kind of like on the camp of a broken clock is right twice a day. But I truly think that he was more right than wrong there. And like I said, Mike Maloney and Peter Schiff are often talking to one another and do joint or collaborative things. So I'm sure Mike Maloney is getting a lot of this from him. Tom P. Yeah, and then this is what Tom is saying. Maloney, Schiff, etc. make their living selling gold and catastrophes. Yeah, so they're both in the same bucket. The imminent collapse has been coming for 40 years. Yeah. Francois, yeah, everybody says that, but I don't know. No. Even if they are right, without good timing, it's not much use. Some people will get the timing right. Check out the Doug Casey on Donahue vid. The collapse was imminent in 1980. Actually, if you go and Google, or not Google, go to YouTube and do imminent crash or market crash, and then put a date next to it, like 1997, 98, 99. It's very interesting because you see basically the same videos, the same people every year, and then you'll see that that it will increase in the number of overall views or instances of these things every year. So it's just the same thing getting churned. James says, when you send option trade alerts, do you actually trade them or just provide alerts? I'm not going to send anything that I don't trade. So that's that. All right. So now we're going to get into options. First of all, I want to dispel a notion that options are about leverage. They are not about leverage. If anyone's telling you that they're about leverage, they don't know how to trade options. Options are all about the odds in the market. The option chain, the option trades, the option contracts across the market are kind of like the big board when you go to a horse race where they lay down all those odds. That's exactly what it is. They are the odds that all the participants in the market that are trading those options cumulatively are showing what is the best chance, or what are the chances of something being in the money. That's what they are. And so that means that we can trade options with those, or be statistically minded when we trade options. So that's the first thing. The second thing is that while options do have a level of leverage, in other words, you can use a small amount of money to control a lot of money, that is not the best way to play options, because if that were what it was all about, it would be relatively simple. It would all be all about just having leverage going. I mean, that's what a future is. You know, you have leverage that controls a lot of money, and you choose a direction. An option has two different characteristics to it that make that whole idea of leverage completely invalid, and they work together. One is the amount of time left on that options contract, and then the other is the relative premium or worth, the extra premium on top of the intrinsic value of an option. So there are two components within every option that make up its price. There is the intrinsic value, if it exists, because some options don't have any intrinsic value because they are out of the money. And then there's the premium. Now, the intrinsic value is really easy to calculate. It's either you're in the money or out of the money, and it's how much you're in or how much you're out that determines the underlying value of the option, because it represents some underlying stock. The premium is something that is added to the option, added to the cost. And the further out you are away from expiration in terms of time, the bigger that premium is. All right? And then as you get closer and closer to expiration, that premium shrinks and shrinks and shrinks and shrinks. It starts shrinking exponentially fast the closer you get to the expiration date. Now, but it's not a linear thing. I mean, you would think, okay, I can then measure that linear or that exponential drop. It's not that way at all, although that is part of it. That is a much more complex calculation. The other thing that affects the amount of premium at any one time is the amount of volatility in that option, in the underlying stock at that time. And it's volatility that has from one time slice to the next, has the most influence on the actual cost or value of an option. So that's really, really important. So now there are basically three dimensions to an option that you have to take control of. The first is volatility, the second is time, and then the third is how bullish or bearish you are. And you can use all three of these things as a way to kind of model your idea of where you think a stock is going and when it's going and under what conditions. That is truly what an option is. Now, you can play options by themselves. Like there's calls and puts. Calls represent bullish cases and puts represent bearish cases. It's all about kind of predicting where a stock is going to be at what time or when. All right. Either it's going to be going up or you're predicting it's going to go down. Going up for calls, going down for puts. But again, it's not that simple. You can both buy and sell a call or buy and sell a put. And there are different responsibilities depending on whether or not you're a buyer or a seller. Essentially, when it comes to premium, a buyer is charged the premium. It's an extra cost. If you're a seller, then you're selling that premium. That premium is yours. It's like something that you collect off the option. That's an extremely important point. Another very important point is that most calls expire worthless, like 90% of them. Where do you think that premium goes of all those options that are sold and that become worthless? It goes to the seller. So it stands to reason then that the seller is collecting the majority of the premium. And for that reason, for that very reason, it is far more advantageous to be a net seller of premium or a net seller of options than to be a buyer. Now, for a lot of people, this is, a really complex thing to kind of undertake. But that is the first thing that you need to get under your skin. That is the fundamental tenet of options, that it is better to be a seller of options. In other words, it's better to sell a call than buy a call. It's better to sell a put than buy a put, usually. Let's put it this way. If volatility is very high, then the premium is going to be very, very heavy, bloated. The option is going to be bloated. If it's very bloated, then it's overpriced. It's better to sell it. If the volatility is very low, then it could be that the premium has shrunk down to hardly anything. And then the chances are that if volatility is very low, then it could stay that way or it could go up. That's like buying an option cheap. So if volatility is very low and premium is cheap, then it's better to buy the option. That is a very, very difficult thing for the average trader to do and to ascertain. It's not impossible. You can set up some parameters around that and only buy or sell options when premium is high and buy them when premium is very low or volatility is very low. That will help some. But still, it's very, very difficult. There are different strategies, though, that you can employ where you can take different options and combine them into these strategies where it takes a lot of the risk out of your hands. And those are things that we'll talk about in the future. The other great thing about options is that if you have a very, very small trading account, you can actually participate in the options game in a way that would be even easier to participate in just buying and selling regular stocks or futures. That's because you can control the risk and you can trade relatively large amounts of capital for very, very little cost. And that's really important. So the caveat to all of this is that options are not simple. But with a little bit of groundwork and some basic understanding of what they are, and an understanding of the different type of strategies like spreads or iron condors or strangles and how they're used and when they're used, under what conditions in the market, you can actually simplify it down to just a few solid strategies that you can use, that you can employ, and that will cost you very little money and have very well-defined risk. Now, the cool thing about options and well-defined risk is, unlike stocks where you set a stop and you think that you're defining the risk with a stop, if price hits a stop, you're out of the trade, you lose. If price hits the risk parameter on an option, you're still in the trade until the expiration, so it could come back. So it gives you an opportunity to stay in the game. That's a huge, huge difference between options and stocks. Again, if you're in a stock and you hit a stop, you're out. You lose the money. You're in an option and you come down to that level of defined risk, it just stops there, you know, the amount of loss that you have. But if you're given enough time, it could move off of that and you can stay in the position and then actually ultimately win. So so those are some of the things. Then, you know, of course, you got to be careful if you have a small account, what types of strategies you use, what type of stocks that you use, and so forth. Now, one of the things with options that is really important, and to an extent it's also important with stocks, is that generally there's, in a market, in an auction type market, there's the bid side and then the ask side. In other words, there's a spread between the price that you can buy it at and the price that you can sell it at. And that spread is where market makers make their money. That spread is usually determined, or almost exclusively determined, by the liquidity in the market and how many players there are in the market. Now with options, because there are so many different contracts, depending on the underlying stock and how popular it is and the total number of contracts, the number of people that are actually vying for that particular options contract may be large, or it could be extremely small. You might be the only person that's even interested in that contract. So there are certain rules that you want to follow that make it a lot easier. It's a lot easier to trade highly liquid, relatively high volume stocks with a fair amount of volatility. So by choosing stocks that fit that criteria, you're going to have a much easier time getting in and getting out of an option. See, the thing is, if the spread is too big, then you're effectively losing money on both the entry and exit from that option. And so you would have to then add that onto the total amount of money that you would have to make in the option itself, in the contract itself, if you were to exercise that option and you know, if you bought one, sell it. If you sold one, to buy it back, you would have to overcome that slippage, that difference, before you started making profit. So let's say your slippage was $20 added, $10 going in, $10 coming out, but you made $30 on the trade. Well, you'd have to subtract that $20 plus the commission. You end up making less than $10 on that trade, even though you thought you made 30. So that's why it's important to choose stocks that have very, very small spreads. Some stocks only have a penny of spread. And so therefore, you know, you're not having to overcome so much the cost of getting in and out of that option contract. All right, let's see. Let's see what some people have said so far. That's right, Miro. I am serious tonight or today. It is the Professor Mood. Yep. Thank you. Dr. Zayas, I love trading options. 2018 will be my first profitable trading year, mainly due to selling options. Unfortunately, commissions in Canada are still quite high. However, by choosing the right options, I know in your particular case that have small spreads, you can still make money if you're careful, even with a small account. Alex, your explanation is incomplete until you introduce the idea of implied volatility, which is what options. I already said that. I already talked about volatility. And that is going to be probably the main talk of what I'm going to be interjecting with it. And I mean, it was the very first thing that I talked about. Where were you, Alex? For Christ's sake. Versus the realized volume of the asset. That's what drives the premium. That's exactly what I said. Also, buying options give you long volatility exposure. Selling options give you short volatility, which means potentially convex losses. All right. So, Alex, first of all, those are all good points, but those are things that are going to go way over the top of most people's head. And we'll talk about convexity and all that other stuff later, much later. These aren't things that really need to be known by most people. Sell only, Keston says, but you can also buy and make money. All right. I said that it is better, more often than not, to be a net seller of premium than it is to be a buyer. Those are just the odds in your favor. I didn't say don't buy. I said it's better to be a net seller, better to be a net seller, not best. Stab says, what is the option primer? For someone who never dealt with options, can you give practical examples? No, I'm not going to give any examples in this option primer. I'm going to lay down some ground rules, first of all, and that's what I've been going over here. I've said that, first of all, you want to choose stocks that have a lot of liquidity. That means that they have a lot of volume and a lot of people participating in that stock. And also that there's that same kind of liquidity in the options that are that people are using to trade that stock. You want to find options that have a small spread. I mean, in general, that's what you want to do. Sometimes, you know, you'll find that a penny spread is the best. For some larger priced options, you'll find that maybe something a little bit more is okay. Generally, you want to also, and this is a general rule, that buying in the money stocks, stocks that have intrinsic value, will end up costing you a lot more. They'll be more expensive in terms of the amount of dollars, but there's a reason for that. And the reason for that is that they are priced that way because there's a greater chance that they are going to end up worth something at expiration. When you buy or sell out of the money options, they may be cheaper, but you're taking more risk. And there's lesser chance. The market is pricing in a lesser chance to make money. Doesn't mean that there aren't good strategies to buy out of the money or sell out of the money options. There are. You just have to measure the risk with the return. And don't worry, Stab. There's going to be plenty of examples. It's all I'm going to be doing is examples of options going forward. And I'll be getting into the actual particulars of what a call option is and what a put option is. And I'm going to put some videos on, inside the trade room that will be available so that you can watch those anytime you want. I'll also create some courses. Michael Mack says, individual strikes have their own implied volatility measure. How is this different from the standard implied volatility measure of the asset? Individual strikes. No, actually, that is true. That's because it really depends. Again, this is something that the market actually sets from contract to contract. Right now, this is not an important point for most people. Just understanding what the implied volatility of the option is what's important. Alex, telling people who may not be well versed in financial products to sell options is a dangerous strategy. No, it's not. Reckless, in my opinion. Selling options has unlimited downside. You're wrong. Sorry, Alex. And that's not what I said either. The implied volatility depends on many factors called Greeks, and these will vary by strike, among other things. So Greeks is something else that we'll be getting into very heavily, that measure different aspects of the option, where the Greeks will basically be measuring the velocity or acceleration of an option either towards or away from profitability or towards or away from volatility. And these are important things because, like, if you're a buyer of an option that it has very low implied volatility, so you think it's cheap, you would like to make sure that perhaps there's a great potential for it to move towards volatility. So you can measure things like that. You can also measure how fast or how slow it's moving towards a bearish or a bullish attitude. You know, again, but these things are way out there in terms of people that are just starting. And, you know, if it's something that you want to get into earlier, you know, I will try to go, I will try to do things that are like beginner, medium, beginner, medium, beginner, medium, beginner, medium, beginner, medium, something like that. And then medium, advanced, medium, you know, there's no way for me to get into the nitty-gritty of options right from the beginning and make it approachable to people that just aren't familiar with options. And quite frankly, most people that have been trading options forever still don't even understand Greeks or implied volatility. James Push, Karen on Tasty Trade made 41 million in year's profit with 10K. Do you know how she did it? She got lucky. That's how. There's no other way around it. Hero Stream. Ernie, what do you think of the Revolut app? I'm not familiar with it. Free stock trading is coming for Revolut users. Okay, that's cool. I really know nothing about it. Alex says, there's one thing you didn't mention explicitly. Being long options means you have limited downside. Selling options means you have potentially unlimited losses. Yeah, it does. I didn't mention it because it's not important right now. First of all, I'm not advocating anybody go out there and buy and sell options. I wouldn't advocate doing anything unless you knew what you were doing. And until I start explaining the actual anatomy of an option and what are the specific rights and obligations of buyers and sellers, respectively, all of this stuff is mumbo jumbo to people. I understand, but I think what you're saying is incomplete. So I don't understand with some of you guys, Alex and Keston. It's like I speak for 5 minutes and you expect me to put every single bit of information there is in 5 minutes and not wait for the next 5 minutes. My God, what is up with you guys? It's not going to be an easy thing if this is what you're going to do is complain about, you know, the way I present material, right? And as I said, this is a primer. I am simply giving big ground rules. I'm saying that for inexperienced traders, it's going to be a little difficult to start understanding these concepts. For experienced traders that are stuck in certain ways of thinking about options, it's going to be hard for you too. Because I know that most of you are doing shit wrong. Some of you may be doing okay, and that's great. Fine. You may just be here to pick up some ideas, and that's fine. I'd be happy to hear your ideas as well. But for most people that are inexperienced or medium experienced, they're going to need a broader understanding of this stuff first, and then drill down to the individual areas, and then a simplification of it all. Sort of ground rules, tenets, what to follow, so that it keeps them out of trouble. Just because you're selling options does not mean that it's a risky proposition or being a net seller of premium. Now, I didn't say it's better to sell options. That's very, very different from what I said, Alex. I said it's better to be a net seller of premium. Very, very different. All right. So hopefully I made all of that very, very clear. And, you may find that, I have a lot of patience, but my patience is limited, because I'm trying to get concepts across. I don't mind if people think that they know more than me and want to try to correct me, but to try to take over the chat, and show just how much you think you know, is not helping everybody else. What I would prefer is that people take a step back and try to help those that don't understand. That would be way better. And it will work better for everybody. And if you don't like my attitude, tough. That's the way it goes. I haven't changed in the past 25 years, maybe longer. I don't plan on changing anytime soon. All right. I guess we're about half hour, 40 minutes into this, and I think that's enough for now. So tomorrow I'm going to talk about the basic constructs of an options contract, whether it's a call or a put, and then we'll talk about different types of strategies and how they're used, whether they're spreads or strangles or iron condors or whatever. We'll talk about things that have defined risk and then things that have undefined risk. And I want to say this right up front. Strategies that have undefined risk are not less risky. Or I'm sorry, are not more risky. They have theoretical more risk, but that doesn't mean in actuality they have more risk. Right? What that means to say is that when you start looking at the occurrences over big numbers, you'll actually find that strategies that have at least some undefined risk typically have greater probability of profit and higher return in the long run. All right, so there's a very good question by Crypto Show. What are the best platforms to trade options? And so I would say unequivocally that Tasty Trades, Tasty Works is a good platform. And probably the de facto standard platform, in my view, is Thinkorswim by TD Ameritrade. TD Ameritrade is where I'm going to be doing almost all the demonstrations that I'll do. I'll also look at Tasty Works and do some demos there as well. All right. I'm actually going to do the demonstrations in TD Ameritrade's Thinkorswim, and you can get an account there relatively easily. I'll also talk about getting an options account because that's going to be an important skill that you'll need to get the kind of options trading account that you want, because there are different levels that they allow you that will only allow certain types of strategies that you can run. And you're going to want to do a lot of different things. And the reason why they do this is there's this perceived notion that if you take on certain types of strategies without knowing what you're doing, without the experience, that there's a greater chance that you're going to blow up your account, which is true. and not so true. And we're going to go over all that as well. So in my view, best platforms are Thinkorswim by TD Ameritrade and Tastyworks by Tastytrade. There are other platforms like Interactive Broker. Their platform sucks. TradeStation, their options platform totally blows. There are also options trading platforms that are more web-based. Some of them are okay. All right. That's about all I have to say today. Hopefully, all of this was informative. So I'll repeat what I just said, so that we go full circle here. Yeah, I'll look at Revolut. No idea what it is. So again, we're going to look at the construct of calls and options. Those are the two basic things that you can trade, and what they mean in terms of rights and obligations. Rights are what the buyer has. Obligations is what the seller has. We'll also look at what an option is, or how you actually trade it. What is an options chain, which are all the different contracts and how they work, and what are all the different factors that that you can look at. But we're going to try to simplify a lot of that so that you don't go overboard. We'll also look at it from a statistical point of view. We'll look at two different ways of trading. One is the big numbers way of trading. That's where you make a lot of small trades and point all your strategies towards a specific potential of profit or percent of profit and a return on capital. Both of those things can be controlled based on the type of strategy that you put on. And if you put on enough of them with the same criteria over a long term, that is what your account will be heading towards. So in other words, if you wanted to have an account that was heading towards 70% win rate and say a 40% return on your capital, and over a long period of time, after a lot of trades, that's exactly what you're going to do. All right. Now, if there are other ways to trade, you can take, your best idea, and as long as you know the risk and it works within the larger strategy of your overall account, you can do it that way too. Try to hit some home runs with defined risk. I mean, that's another possibility. So that's the blended possibility with multiple trading strategies. And then there's the other strategy of just trading options with those multiple strategies. And then choosing the right strategy for the right situation. All right. So Miro says, best platforms to trade options for newbies is Tasty Balls, Swim and Drown. I say it's Flounder and Drown. Ernie, don't change. That's why we love you. Cool. All right, that's all I have to say for today. Tomorrow, we're going to start talking about the nitty-gritty of calls and puts. All right, and we'll take a look at it in the Thinkorswim trading platform. If you you can open up an account in Thinkorswim relatively easily, and I think they require like a $2,000 minimum deposit. But don't turn on options or anything like that. Just stick with the paper trading for now. There's going to be some. If you open up an options account, you'll need to answer questions in a certain way in order to unlock certain features. So we'll talk about that too. When you go to Tastytrade and their Tastyworks, actually I think it's just Tastyworks, they also have this kind of KYC, They all have this, and they want you to prove your expertise or state it. And we'll go over that as well in order to open that account. Otherwise, they will assume that you're a newbie and don't know what you're doing. And that's okay too. I'll also talk about things that, you know, you can open up the minimal amount of levels and what you can do and what you can't do. Ernie, I know nothing about trading. Can you please direct me to a book or something to learn the basics to be able to follow what you're saying? No, there are very, very few books out there. I mean, there's a lot of books. I mean, you can go on the web and learn a lot of this stuff. But just follow along with what I'm saying, and that's all you're going to need. There are lots of other books that I can recommend. Some of them don't necessarily have a lot to do with trading. So, for instance, I recommend the Nassim Taleb trilogy of Black Swan, Anti-Fragile, and Fooled by Randomness. Also Skin in the Game, so I guess there's a quad now. And I recommend that everybody read those books, but they're not going to teach you some of the nuts and bolts here. Just stick with me, and I will show you some of the absolute basics on how you can get started. Alrighty. That's all I've got for now. Thank you very much. We'll see you next video.